Question 1. A registered representative wants to send a sales letter to 15 existing clients about a new mutual fund. Under FINRA rules, how must this communication be handled? A. It must be filed with FINRA at least 10 business days prior to first use. B. It must be approved by a principal before first use and retained by the firm. C. It does not require principal approval or filing because it is sent only to existing clients. D. It must be filed with FINRA within 10 business days after first use. Answer: B. It must be approved by a principal before first use and retained by the firm. Any written communication sent to more than 25 retail investors within a 30 calendar day period concerning a product or service is considered retail communication and must be approved by a qualified principal prior to use. While communications sent to fewer than 25 retail investors are classified as correspondence and may only require principal review instead of pre-approval depending on firm procedures, this question specifies a sales letter to 15 existing clients, making it correspondence that still requires principal approval before use by many firms, or at minimum, review by a principal. Regardless of classification, retail communication or correspondence for more than 12 people, all such communications must be retained by the firm for a specified period, typically 3 years. Always ensure your communications are approved by your principal before sending them out to clients. Question 2. When recommending an investment to a customer, a registered representative must have a reasonable basis to believe the recommendation is suitable based on the customer's investment profile. Which of the following is not typically considered part of a customer's investment profile? A. Investment objectives. B. Financial situation and needs. C. Social media followers. D. Risk tolerance. Answer: C. Social media followers. Suitability standards require registered representatives to understand their customers' financial situation, investment objectives, risk tolerance, time horizon, and other relevant factors to ensure recommended investments are appropriate. These elements form the customer's investment profile, which guides suitable recommendations. A customer's social media following is irrelevant to their financial situation or investment needs and is not a factor used in determining suitability. Always gather comprehensive information about your customer's financial life before recommending any investment. Question 3. A mutual fund's net asset value, NAV, is calculated. A. Only at the close of the business day. B. Continuously throughout the trading day. C. Once per week, usually on Friday. D. At the open of the business day. Answer: A. Only at the close of the business day. Open-end investment companies, also known as mutual funds, calculate their net asset value per share by taking the total value of the fund's assets, subtracting its liabilities, and dividing by the number of outstanding shares. This calculation is performed only once per trading day, typically after the major exchanges close. Orders to buy or sell mutual fund shares are processed at the next calculated NAV, meaning if you place an order during the day, you will receive the price calculated at the end of the day. Remember that mutual fund pricing is forward pricing, based on the next available NAV calculation. Question 4. Which type of investment company issues a fixed number of shares that trade on an exchange or the over-the-counter market? A. Open-end fund, mutual fund. B. Unit investment trust, UIT. C. Variable annuity separate account. D. Close-end fund. Answer: D. Close-end fund. Close-end funds are a type of investment company that issue a limited, fixed number of shares in an initial public offering, IPO. Unlike mutual funds, these shares do not redeem directly with the fund but instead trade on secondary markets like stock exchanges, just like the shares of publicly traded companies. The price of a close-end fund's shares is determined by supply and demand in the market and can trade at a premium or discount to the fund's net asset value, NAV. Think of close-end funds like regular stocks that hold a portfolio of other investments. Question 5. An individual opens a traditional IRA. What is the tax treatment of contributions made to this account? A. Contributions are always tax deductible. B. Contributions are never tax deductible. C. Contributions may be tax deductible depending on income and retirement plan coverage. D. Contributions are taxed annually but withdrawals in retirement are tax-free. Answer: C. Contributions may be tax deductible depending on income and retirement plan coverage. Contributions made to a traditional IRA may be tax deductible in the year they are made, depending on the individual's adjusted gross income, AGI, and whether they or their spouse are covered by a retirement plan at work. If neither is covered by a workplace plan, contributions are generally deductible regardless of income. If covered, deductibility phases out at higher income levels. This contrasts with Roth IRAs, where contributions are made with after-tax dollars. Remember that traditional IRAs offer potential upfront tax benefits, while Roth IRAs offer tax-free withdrawals in retirement. Question 6. Under FINRA rules, which of the following must be approved by a registered principal before use? A. Correspondence sent to a single retail customer. B. Internal firm memos regarding compliance procedures. C. Retail communication used to promote investment company shares. D. Public appearances by a registered representative at a local library. Answer: C. Retail communication used to promote investment company shares. FINRA Rule 2210 categorizes communications with the public and sets approval requirements. Retail communication, which is broadly defined as any written or electronic communication made available to more than 25 retail investors within 30 days, must be approved by a qualified principal before its initial use. Correspondence, sent to 25 or fewer retail investors, and institutional communications, sent only to institutional investors, generally have different supervision standards. Advertising and sales literature promoting investment companies, which typically reach a broad audience, fall under the retail communication category. Always get principal approval for materials distributed widely to the public. Question 7. An investor redeems shares of a mutual fund. How is the redemption price determined? A. The highest bid price on the open market. B. The net asset value, NAV, calculated at the time of redemption. C. The original purchase price plus any appreciation. D. The net asset value, NAV, next calculated after the redemption request is received. Answer: D. The net asset value, NAV, next calculated after the redemption request is received. When an investor redeems shares of an open-end mutual fund, they sell their shares back to the fund itself. Mutual funds are required by law to process these redemptions at the next net asset value, NAV, calculated after the redemption order is received. This is known as forward pricing. For example, if an investor places a redemption order during the trading day, they will receive the NAV that is calculated at the close of the market that day. This ensures fair and consistent pricing for all shareholders. Question 8. All of the following are characteristics of a variable annuity except: A. It offers guaranteed investment returns. B. It has a separate account that is professionally managed. C. It provides a death benefit to beneficiaries. D. It is considered a security. Answer: A. It offers guaranteed investment returns. A variable annuity is a contract with an insurance company that provides a stream of payments in the future, often for retirement. Unlike fixed annuities, variable annuities do not offer guaranteed investment returns because the funds invested in the separate account fluctuate based on the performance of the underlying investment options, subaccounts. Variable annuities are considered securities because their value depends on the performance of these investments and are subject to regulation by the SEC and FINRA. They typically include a death benefit feature and are managed in a separate account to isolate assets from the insurance company's general account. Be sure to explain that variable means the returns are not guaranteed. Question 9. Which entity is primarily responsible for enforcing the Securities Act of 1933 and the Securities Exchange Act of 1934? A. Financial Industry Regulatory Authority, FINRA. B. Municipal Securities Rulemaking Board, MSRB. C. Securities and Exchange Commission, SEC. D. Federal Reserve Board, FRB. Answer: C. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the primary federal regulatory agency responsible for overseeing the securities markets, protecting investors, and maintaining fair and orderly markets. The SEC was established by the Securities Exchange Act of 1934 and is responsible for administering and enforcing key federal securities laws, including the Securities Act of 1933, which regulates new issues, and the Securities Exchange Act of 1934, which regulates the secondary market and market participants. FINRA is a self-regulatory organization that oversees broker-dealers but operates under the SEC's authority. Remember, the SEC is the top cop of the federal securities market. Question 10. A customer wants to open a joint account with their spouse. The customer requests that either party be able to make transactions in the account independently. This describes which type of joint account? A. Joint tenancy with right of survivorship, STROs. B. Tenancy in common, TIC. C. Community property account. D. Sole proprietorship account. Answer: A. Joint tenancy with right of survivorship, STROs. Joint accounts allow two or more people to share ownership. A joint tenancy with right of survivorship, STROs, account is structured so that if one account holder dies, their share of the account automatically passes to the surviving account holders, bypassing probate. A key characteristic of STROs accounts is that each tenant has an undivided interest in the entire account, and any owner can typically make trades or request distributions without the consent of the other owners. This differs from tenancy in common, TIC, where each owner's share is specified, and upon death, their share passes to their estate. STROs is common for spouses. Question 11. What is the primary difference between an open-end management company and a closed-end management company? A. Open-end funds trade on exchanges, while closed-end funds do not. B. Open-end funds issue a fixed number of shares, while closed-end funds continuously issue shares. C. Open-end funds redeem shares directly with the fund, while closed-end fund shares trade on secondary markets. D. Open-end funds can invest in equities and bonds, while closed-end funds can only invest in equities. Answer: C. Open-end funds redeem shares directly with the fund, while closed-end fund shares trade on secondary markets. The fundamental difference lies in how shares are bought and sold after the initial offering. Open-end funds, mutual funds, continuously offer new shares to investors and stand ready to redeem existing shares from investors directly with the fund. Closed-end funds, however, issue a fixed number of shares in an IPO, and those shares then trade between investors on stock exchanges or the OTC market. The price of a closed-end fund's share is determined by market supply and demand, not its NAV alone. This redemption mechanism is the key differentiator. Question 12. A registered representative is explaining the fees associated with a mutual fund to a client. Which of the following is not a fee typically associated with mutual fund ownership? A. Management fee. B. 12b-1 fee. C. Premium over par. D. Sales charge. Answer: C. Premium over par. Mutual funds, being investment companies, charge various fees and expenses to cover their operational costs and management. Common fees include the management fee, paid to the investment advisor, the 12b-1 fee, used to pay for marketing and distribution costs, and sales charges, loads, for funds that are not no-load. A premium over par is a term associated with fixed income securities, like bonds, indicating the purchase price is above the bond's face value, not a fee charged by a mutual fund. Make sure you can identify the common fees deducted from a mutual fund's assets or charged directly to investors. Question 13. Which of the following statements about variable annuities is correct? A. The value of accumulation units is fixed once purchased. B. During the annuity phase, the number of annuity units is fixed. C. Variable annuity payments during the annuity phase are fixed. D. The separate account guarantees a minimum rate of return. Answer: B. During the annuity phase, the number of annuity units is fixed. A variable annuity has two phases: the accumulation phase, when contributions are made, and the value is tracked using accumulation units, and the annuity phase, when payments begin, and the value is tracked using annuity units. During the accumulation phase, the number of accumulation units increases with contributions, and their value fluctuates. When the investor annuitizes, accumulation units are converted into a fixed number of annuity units. The value of each annuity unit, and thus the size of the periodic payments, will fluctuate based on the performance of the underlying investments in the separate account. Remember that in the annuity phase, the number of units is fixed, but their value varies. Question 14. A customer wants to invest $20,000 in a class A mutual fund that has a breakpoint schedule offering a reduced sales charge for investments of $25,000 or more. The registered representative should: A. Immediately sell the customer $20,000 worth of shares at the standard sales charge. B. Advise the customer that they should not invest in this fund if they cannot reach the breakpoint. C. Inform the customer about the breakpoint at $25,000 and ask if they would consider investing a larger amount to qualify for the reduced sales charge. D. Invest the $20,000 and promise to apply the breakpoint retroactively if they invest more later. Answer: C. Inform the customer about the breakpoint at $25,000 and ask if they would consider investing a larger amount to qualify for the reduced sales charge. Registered representatives have an obligation to explain available breakpoint discounts to customers. Failing to inform a customer about a breakpoint for which they are close to qualifying, leading them to pay a higher sales charge than necessary, is a violation known as a breakpoint sale. In this situation, the representative must inform the customer about the $25,000 breakpoint and give them the opportunity to decide if they want to invest the additional $5,000 to achieve the lower sales charge. Avoid selling just below a breakpoint without discussing it with the client. Question 15. Under FINRA rules, if a customer complaint involves an allegation of theft or misappropriation of funds, what action must the firm take? A. The complaint must be reported to FINRA immediately, but no later than 30 calendar days. B. The complaint must be reported to the SEC within 10 business days. C. The firm must retain the complaint for 3 years but is not required to report it to regulators. D. The firm must attempt to resolve the complaint within 60 days and only report it if unresolved. Answer: A. The complaint must be reported to FINRA immediately, but no later than 30 calendar days. FINRA Rule 4530 requires member firms to report specified events, including written customer complaints alleging theft, misappropriation of funds or securities, or forgery, to FINRA within 30 calendar days of discovery. While all written customer complaints must be handled and retained, those involving serious allegations like theft have specific, accelerated reporting requirements to FINRA. Ensure you understand which types of complaints trigger mandatory reporting to FINRA. Question 16. The maximum sales charge allowed on the purchase of mutual fund shares, according to FINRA rules, is: A. 5% of the public offering price, POP. B. 8.5% of the net asset value, NAV. C. 8.5% of the public offering price, POP. D. 9% of the net asset value, NAV. Answer: C. 8.5% of the public offering price, POP. FINRA rules limit the maximum sales charge that can be imposed on the purchase of mutual fund shares. This limit is set at 8.5% of the public offering price, POP. The POP is the price paid by the investor, which includes the net asset value, NAV, plus the sales charge. Funds that charge the maximum sales charge must offer specific features, such as breakpoints, reduced sales charges for larger investments, and rights of accumulation. Know that the 8.5% limit is calculated on the POP. Question 17. Which of the following types of investment companies does not issue redeemable shares? A. Open-end fund. B. Unit investment trust, UIT. C. Closed-end fund. D. All of the above issue redeemable shares. Answer: C. Closed-end fund. Redeemable shares are those that the investor can sell back to the issuing fund or company. Open-end funds, mutual funds, and unit investment trusts, UITs, issue redeemable shares. Investors wishing to exit these investments sell their shares back to the fund or trust at the current net asset value, NAV. Closed-end funds, on the other hand, have a fixed number of shares that trade on the secondary market between investors. To sell shares of a closed-end fund, an investor sells them on an exchange, not back to the fund itself. Remember, you redeem shares back to an open-end fund or UIT, but you sell shares of a closed-end fund on the market. Question 18. A registered representative's employing broker-dealer must approve which of the following activities of the registered representative? A. Serving as a volunteer coach for a local youth sports team. B. Purchasing a personal residence using a mortgage from a local bank. C. Opening a brokerage account at another member firm. D. Participating in a private securities transaction for a family member without compensation. Answer: C. Opening a brokerage account at another member firm. FINRA Rule 3210 requires that an associated person, such as a registered representative, obtain the prior written consent of their employing member firm before opening a brokerage account at another member firm. The employing firm must also be notified in writing of the person's association with the firm, and the executing firm must send duplicate statements and confirmations upon request. This rule is in place to allow the employing firm to monitor the representative's personal trading activities. While other activities like OBA, outside business activities, might require notification, opening a securities account elsewhere requires explicit prior written consent. Question 19. A customer invests in a variable annuity subaccount that tracks the S&P 500 index. During the accumulation phase, the value of their investment will fluctuate based on A. A guaranteed minimum rate of return. B. The performance of the underlying index. C. A fixed interest rate declared by the insurance company. D. The performance of the insurance company's general account. Answer: B. The performance of the underlying index. Variable annuities allow investors to allocate contributions to various investment options within a separate account, often called subaccounts, which function much like mutual funds. The value of an investor's accumulation units in a subaccount is directly tied to the performance of the securities held within that specific subaccount. If a subaccount tracks an index like the S&P 500, the value of the investor's interest will rise and fall with that index's performance. This is the variable aspect of the annuity, as returns are not guaranteed. Question 20. All of the following fall under the definition of a security under the Securities Act of 1933 and the Securities Exchange Act of 1934, except A. Shares of an open-end investment company, mutual fund. B. A variable annuity contract. C. A fixed annuity contract. D. Shares of a closed-end investment company. Answer: C. A fixed annuity contract. Securities are investments where a person invests money in a common enterprise with an expectation of profits derived solely from the efforts of others. Mutual funds and closed-end fund shares clearly fit this definition. Variable annuities are also considered securities because their value and future payout potential depend on the performance of the underlying investments in the separate account. Fixed annuities, however, are considered insurance products, not securities, because the insurance company guarantees both the principal and a minimum rate of return, and the investor does not participate in market fluctuations. Know that fixed annuities are not securities, but variable annuities are. Question 21. What is the primary purpose of the Securities Act of 1933? A. To regulate trading in the secondary market. B. To require registration of new securities issues. C. To establish rules for margin accounts. D. To govern broker-dealer registration and conduct in the secondary market. Answer: B. To require registration of new securities issues. The Securities Act of 1933, often called the Truth in Securities Act, is the primary federal law regulating the primary market, meaning the initial issuance and sale of securities to the public. Its main objective is to ensure investors receive adequate disclosure about new securities being offered, requiring issuers to register securities with the SEC and provide potential investors with a prospectus containing material information. The Act aims to prevent fraud in the initial offering process. The 1934 Act focuses on the secondary market and market participants. Question 22. An investor wants to purchase a mutual fund and will need access to the funds again in approximately 18 months. Considering this time horizon, which share class would likely be most appropriate? A. Class A shares with a front-end load. B. Class B shares with a contingent deferred sales charge, CDSC. C. Class C shares with a level load and small CDSC for 1 year. D. Class D shares with low expenses but no sales charge. Answer: C. Class C shares with a level load and small CDSC for 1 year. Mutual fund share classes have different fee structures that impact suitability based on the investor's time horizon and investment amount. Class A shares are best for larger investments and longer time horizons due to the upfront sales charge and potential breakpoints. Class B shares have a back-end CDSC that declines over several years and then typically converts to Class A. They are generally suitable for medium-term investors, 5 to 7 years, but have higher annual expenses. Class C shares, often called level load or stub load shares, have a small annual 12b(1) fee and often a small CDSC that disappears after only 1 year. They are typically most suitable for investors with shorter time horizons, 1 to 3 years, because the total costs over a short period are usually lower compared to Class A or B shares. Class D shares have low or no sales charges but may have other fees. Suitability depends on the specific structure. For an 18-month horizon, Class C shares are often the most cost-effective option compared to A, where the upfront load is high for a short hold, or B, where the CDSC would still be in effect and high. Understand the different share classes and how their fee structures impact suitability based on time horizon. Question 23. An investor in a mutual fund receives periodic payments from the fund. Which of the following represents income distributed by the fund? A. Appreciation in the net asset value, NAV. B. Sales charges. C. Dividends and capital gains distributions. D. Fund expenses. Answer: C. Dividends and capital gains distributions. Mutual funds pass income and realized gains from their portfolio holdings through to their shareholders. Dividends are received from the stocks held by the fund, and interest is received from bonds. Capital gains distributions occur when the fund sells portfolio securities for a profit and distributes those gains to shareholders. NAV appreciation reflects unrealized gains or income/gains not yet distributed. Sales charges and fund expenses are costs, not income received by the investor. Remember that mutual fund distributions, dividends, interest, and capital gains, are taxable events for the investor, regardless of whether they are taken in cash or reinvested. Question 24. A customer opens a new brokerage account. Under FINRA rules, what must a registered representative make reasonable efforts to obtain from the customer when opening the account? A. A letter of intent. B. A written power of attorney. C. Information regarding the customer's investment objectives and financial situation. D. Consent to receive electronic communications. Answer: C. Information regarding the customer's investment objectives and financial situation. The core principle of the suitability rule, and regulation best interest, requires firms and representatives to understand their customers. When opening a new account, the firm must make reasonable efforts to obtain essential information about the customer's investment profile, which includes their investment objectives, financial situation and needs, such as income, assets, tax status, investment experience, risk tolerance, and time horizon. This information is crucial for ensuring that any recommendations made are suitable for that customer. While other items listed might be relevant in specific circumstances, obtaining the customer's profile information is a fundamental requirement for opening almost any account. Question 25. An investment company that is organized as a trust, has a fixed portfolio of securities, and terminates on a specific date is best described as A. Open-end management company. B. Closed-end management company. C. Unit Investment Trust, UIT. D. Variable Annuity Separate Account. Answer: C. Unit Investment Trust, UIT. A unit investment trust, UIT, is a type of investment company that has a specific structure. UITs issue redeemable units to investors and typically hold a fixed portfolio of securities, most commonly bonds, which are selected at the inception of the trust and are generally not actively traded. UITs are passive investments that have a defined termination date, at which point the underlying securities are liquidated, and the proceeds are distributed to unit holders. Open-end and closed-end funds are actively managed and do not have fixed termination dates, while variable annuity separate accounts are funding mechanisms for insurance products, not standalone investment companies in this structure. Recognize that a fixed portfolio and a termination date are key characteristics of a UIT.